The dollar's decline and gold's rise, the end of an investing era. Have we reached the end of a 70-year-old financial paradigm? For decades, the bedrock of modern portfolio theory has been the 60-40 allocation model, a seemingly unshakable strategy favoring a 60% allocation to stocks for growth and a 40% allocation to bonds for safety. This principle, born in the 1950s, has guided generations of investors, wealth managers, and pension funds. But what if this cornerstone of investing is not just outdated, but fundamentally broken and incapable of navigating the complexities of the current economic landscape? A seismic shift is occurring at the highest levels of finance, and the tremors are signaling the end of an era. The fundamental problem lies in the deteriorating role of government bonds as a reliable safe haven asset. The core assumption of the 60-40 portfolio was that during periods of equity market turmoil, bonds would rise, providing a crucial buffer. However, this negative correlation is no longer a guarantee. A combination of persistently high inflation, the prospect of lower real interest rates, and unprecedented levels of government debt has rendered sovereign bonds vulnerable. Investors are now facing a reality where the very asset meant to protect them could instead become a source of capital loss, fundamentally undermining the logic that has underpinned portfolio construction for over half a century. This erosion of trust in traditional safe havens has created a dangerous vacuum for investors seeking stability. With bonds offering diminished protection and cash savings being actively devalued by inflation, the established financial order is being called into question. The challenge is no longer simply about achieving growth, but about genuine wealth preservation in an environment where traditional instruments are failing. This predicament has forced the world's largest and most influential financial institutions to seek a viable alternative, an asset that can perform the role that government debt once did, to provide genuine security and act as a counterbalance to risk. The catalyst for this monumental shift has arrived not as a whisper, but as a clear and decisive declaration from the titans of Wall Street. Recently, the chief investment officer of Morgan Stanley, one of the world's most influential banks, articulated a radical departure from convention. He proposed that the traditional 60-40 model should be replaced by a 60-20-20 allocation, effectively cutting the bond portion in half and reallocating a full 20% to gold. His reasoning was direct and unambiguous. He declared gold as the new anti-fragile asset to own rather than treasuries, suggesting that high-quality stocks and gold are now the premier hedges in a portfolio. This public endorsement from a firm of Morgan Stanley's stature is more than a mere tactical adjustment. It represents a profound strategic pivot. It signals that the smartest minds in finance are fundamentally reevaluating the nature of risk and safety in the modern economy. The bank's CIO specifically observed how gold demonstrated its new role earlier in the year, rising in value even as the S&P 500 experienced significant downturns. This behavior defies the outdated models that many investors still cling to, which often predict a sell-off in metals during a broad market crash. This institutional awakening is a clear sign that gold is no longer a peripheral asset, but is moving to the very core of strategic wealth management. While Morgan Stanley's announcement made headlines, they were in fact following an even larger and more influential entity. BlackRock, the world's largest asset manager with an astonishing $11.5 trillion in assets under management, had already signaled this paradigm shift. In their fall investment report, the firm advised investors to consider gold as a potent alternative to the growing challenges within the stock and bond markets. They issued a stark warning on bonds, highlighting a scenario where a combination of falling interest rates and persistent inflation could drive real returns on cash and bonds into negative territory, forcing investors to seek sources of reliable income and stability elsewhere. The significance of BlackRock's guidance cannot be overstated. With assets under management that dwarf those of most nations, when BlackRock makes a strategic move, the entire global market feels the gravitational pull. Their track record for market timing is formidable. One only needs to look at their entry into Bitcoin. They began advising clients to gain exposure to the cryptocurrency in early 2024, perfectly coinciding with the launch of their Bitcoin ETF. Since their initial purchases, the price of Bitcoin has surged dramatically. This history underscores a critical lesson for all investors. BlackRock doesn't merely follow trends, it creates them. Their turn towards gold is not a casual recommendation. It is a declaration of where global capital is heading next. Compounding this institutional rotation into precious metals is the concurrent and accelerating weakness in the U.S. dollar. As we have moved through 2025, the dollar has been in a steep decline, pressured by a confluence of factors including slowing U.S. economic data, expectations of Federal Reserve rate cuts, and systemic concerns about U.S. fiscal stability. This emerging weakness is not a short-term fluctuation, but the potential beginning of a long-term structural bear market for the dollar, fueled by the undeniable global trend of de-dollarization as nations seek to reduce their dependence on a single currency for trade and reserves. This brings us to the tipping point, the critical juncture where this confluence of factors becomes an irreversible market force. We are witnessing the world's largest money managers pivot to gold, not after a dollar collapse, but in anticipation of it. Central banks have already been leading this charge, quietly accumulating physical gold at a historic pace for several years. The convergence of institutional investment, central bank buying, and a structurally weakening dollar creates a powerful trifecta that is set to propel precious metals into a new secular bull market. This is the moment where the old rules cease to apply, and a new financial landscape begins to take shape. The immediate impact of this shift is a fundamental repricing of gold and silver. To understand the potential magnitude of the coming move, we can look to the last major precious metals bull market of the 2000s for a historical analog. The period between 2003 and 2006 offers a compelling parallel to our current situation. At that time, similar signals were present. The launch of the first gold and silver ETFs introduced institutional money to the sector, and the U.S. dollar was entering a prolonged bear market. During that initial phase from January 2003 to the highs of 2006, the market saw spectacular gains, with gold rising 110% and silver surging an incredible 219%. Many investors at that point might have concluded that the best returns were already behind them. However, they would have been profoundly mistaken. The most significant and powerful phase of that bull market occurred in the 5 years that followed, from 2006 to the ultimate peak in 2011. This history lesson is critical. The initial surge was merely the prelude to the main event. Today, we find ourselves in a similar position, somewhere analogous to that 2003 to 2006 window. We have already witnessed impressive run-ups in the prices of gold and silver, leading some to question if they have missed the opportunity. However, the institutional capital flows are only just beginning to accelerate. The primary difference this time around is the proactive stance of major institutions and central banks, which are positioning themselves ahead of the dollar's decline rather than reacting to it. This suggests that the coming bull market could be even more powerful and sustained than the last. For silver investors specifically, the current price action presents a pivotal moment. As the price approaches the historically significant level of $50 per ounce for only the third time in history, the temptation to take profits or hesitate on new purchases will be immense. While some technical resistance and a modest pullback at this level are certainly possible, viewing it as a terminal peak would be a grave strategic error. If this analysis of being in the early to mid stages of a major bull cycle is correct, then $50 silver is not an endpoint, but merely a milestone on the path to much higher valuations. The forces propelling silver are multifaceted. Its role as a monetary metal provides a safe haven demand similar to gold, while its indispensable use in modern industry, from solar panels to electric vehicles, creates a powerful and growing demand floor. During the last major cycle, silver dramatically outperformed gold in the later stages, a pattern that is common in precious metals bull markets. Quitting or reducing positions now would be akin to leaving the stadium in the early innings of what promises to be a historic game, potentially forfeiting the largest and most explosive gains that are yet to come. This new reality for precious metals necessitates a critical reevaluation of how investors should own them. For decades, a clear dichotomy has existed between investors motivated by fear and those motivated by greed. The greed investor seeking to capitalize on price trends for a fiat currency gain may find exchange-traded funds or ETFs to be a suitable vehicle. They offer the convenience of easy entry and exit, allowing for quick profit-taking in US dollars without the logistical challenges of handling physical metal. However, for the fear investor, one who is fundamentally skeptical of the paper-based financial system and seeks to protect wealth from systemic events like a currency crisis, the structure of most ETFs presents an unacceptable counterparty risk. When you purchase shares in a standard gold or silver ETF, you are not purchasing the metal itself. You are purchasing a share in a fund that owns the metal, and your share is ultimately a claim on the price of that metal, denominated in a potentially failing currency. The core issue, which is often buried in the fine print of prospectuses, is the mechanism for settlement. Most of these financial instruments are designed to track a commodity's price, not to provide ownership of it. In an extreme financial event or a currency collapse, the fund manager often reserves the right to liquidate the fund's assets, the physical gold and silver, and distribute the proceeds to shareholders in the fund's base currency. This means that in the very scenario you sought to protect yourself from, your position could be forcibly settled in the very same worthless paper currency you were trying to escape. This fundamental weakness is not a secret conspiracy. It is an open feature of the product design. The European Central Bank itself sounded an alarm on this very issue, warning that even minor destabilizations in the financial system could trigger chaos in the gold market. They foresaw a scenario where a flood of investors, traders, and speculators holding vast amounts of paper gold claims would scramble to cover their positions with a severely limited supply of physical gold, creating a catastrophic decoupling between the paper price and the physical reality. Some experienced investors might point to the Sprott Physical Metals ETFs, known by their tickers PHYS for gold and PSLV for silver, as a superior alternative. It is true that these trusts are structured differently, allowing shareholders to redeem their shares for the actual physical metal. However, this feature comes with a critical caveat that renders it inaccessible to the vast majority of investors. The redemption privilege is subject to extremely high minimum thresholds. To redeem shares of the PHYS Gold ETF, an investor must hold an equivalent of at least one 400-ounce London Good Delivery gold bar. For the PSLV Silver ETF, the minimum redemption is an astonishing 10,000 ounces of silver. At current market prices, these thresholds require an investment of approximately $1.5 million for gold and nearly $500,000 for silver. For any investor holding less than these substantial amounts, their claim to the physical metal is purely theoretical. In practice, their investment functions no differently than any other paper-based ETF. This analysis leads to an unavoidable conclusion for anyone serious about wealth preservation. Direct physical ownership of gold and silver is the only strategy that eliminates counterparty risk and ensures true possession of the asset. Once this decision is made, the next critical question becomes what form of physical metal to own. For years, the conventional wisdom for gold investors, particularly in the middle class, has been to accumulate one-ounce coins. The logic was sound. They carried lower premiums than smaller fractional pieces and were highly liquid due to strong global demand. However, the rapidly rising price of gold is creating a significant affordability crisis that challenges this long-held strategy. What was once the foundational pillar of a stacker's position, the one-ounce gold coin, is now becoming financially unattainable for the average person. We are fast approaching a future where owning a full ounce of gold in a single coin might be viewed with the same sense of scale as owning a full kilogram bar of gold is today, an asset reserved for the exceptionally wealthy rather than a tool for the prudent saver. The same affordability issue is afflicting silver. The 100-ounce silver bar, long favored by experienced stackers for its low premium over spot price, is now a significant capital outlay. Based on recent savings data, a typical American would need to allocate their entire year's savings just to acquire approximately 77 ounces of silver, placing even a single 100-ounce bar out of reach. This declining affordability is a critical signal that investors must adapt their accumulation strategies to the new reality of higher prices. This necessitates a strategic shift towards smaller denominations. While 1-ounce gold coins and larger silver bars still have a place in a well-structured portfolio, it is imperative to begin incorporating smaller, more divisible units. The reality we must prepare for is not just continued price inflation or a potential currency crisis, but a world where the real, tangible value of these metals is significantly higher. This preparation involves ensuring that our holdings are practical for a future, where they may need to be sold or traded in smaller increments. The argument that only the value of fiat currency declines while the value of gold and silver remains constant is a gross oversimplification and is demonstrably false. The true purchasing power of precious metals is increasing. In a healthy, technologically advancing economy, productivity gains should lead to a decrease in the cost of goods. While this deflationary pressure is masked by the constant debasement of currencies like the US dollar, it becomes starkly clear when measured in terms of gold and silver. A perfect illustration of this principle can be seen in the evolution of the Apple iPhone. The first iPhone, released in 2007, cost $499. The most recent model was released at a price of $799, representing a 60% increase in US dollar terms. However, when measured in sound money, the story is completely different. That first iPhone cost nearly a full ounce of gold, or about 40 ounces of silver. Today, the far more advanced model costs approximately a quarter of an ounce of gold and around 17 ounces of silver. This represents a staggering 72% decrease in its real cost when measured in gold and a 57% decrease when measured in silver. This is not just an academic observation. It is a powerful demonstration of how far our holdings in precious metals will go in the future. It proves that we are not merely preserving wealth. We are accumulating an asset that is growing in its real-world purchasing power. This is the fundamental reason why owning practical, smaller denominations is becoming increasingly critical. Therefore, a modern stacking strategy should actively incorporate fractional gold, such as quarter-ounce coins and smaller unit silver, like pre-1965 US junk silver coins. These forms of metal offer greater flexibility and will become the new standard as affordability continues to decline. The argument some make against fractional gold, citing the higher premiums, has been proven short-sighted. An investor who dollar-cost averaged into quarter-ounce gold coins over the past 2 years would have not only achieved a lower average cost basis despite the premiums, but would also now possess a far more flexible and divisible store of wealth. This enhanced flexibility is not a minor benefit. It provides the ability to liquidate smaller portions of a position to cover minor emergency expenses, without being forced to sell a large, indivisible unit like a 1-ounce coin or a 100-ounce silver bar. In a future where these larger units represent a significant amount of purchasing power, the ability to transact in smaller increments will be invaluable. The market is changing, and our strategies must evolve with it to remain effective. In conclusion, the lesson for every investor is that a profound structural change is underway. The era of the 60/40 portfolio is ending, not by choice, but by necessity, as sovereign bonds can no longer fulfill their role as a reliable safe haven. The world's largest financial institutions are leading a historic rotation into gold, recognizing it as the premier anti-fragile asset for the modern era. This institutional shift, coupled with a structurally weakening US dollar and relentless central bank buying, is creating the perfect storm for a powerful and sustained bull market in precious metals. Our place in this timeline is still early, analogous to the initial powerful uplift seen between 2003 and 2006, which preceded the even larger gains that followed until 2011. This means the greatest opportunities are still ahead of us. To capitalize on this, investors must understand the critical distinction between paper claims on metal and true physical ownership, opting for the latter to eliminate counterparty risk. Finally, we must adapt to the new reality of rising real value by diversifying our physical holdings into smaller, more practical denominations that will serve us in a future where the affordability and utility of our wealth will be paramount. The landscape is changing, and those who recognize and adapt to this new paradigm will be the ones who not only preserve but significantly enhance their wealth in the years to come.